It gives me great pleasure to welcome all of you to ULI New York's Real Estate Outlook 2014 program.
I think that a more important thing is not sort of what happens to kind of the best assets in New York, kind of the trophy space, which I think is on its own sort of plane. I think a bigger question is what happens to the next year? So what happens to the B asset that's on 6th Avenue that needs a lot of capital, right? What do investors view that asset like? What happens, so I saw a recent deal package for a collection of C office assets that needed a lot of capital. You had a lot of leasing, so the in-place cap rate was, call it 3. So if you turned the building, put in all the capital, did all the leasing, you would stabilize at just over a 5 cap rate. Now, I look at that and I kind of go, it's a lot of work. And the key thing that would make this interesting is it shares an area code with a lot of trophy stuff, but it's not trophy. And if I'm kind of looking on a risk-adjusted basis, I don't know that I find that exciting, right? I think there's a lot more low-hanging fruit in the rest of the country than doing all that work. I think that it's assets that are not the trophy, where if we don't get the growth, that we'll see, I think, the softness perhaps more than people expect.
What's the next neighborhood in New York that's going to blossom? So, Bob, I'll throw that one to you, and then I'll give you, Randy, the sort of bigger U.S. look at it, which is, where are we going to urbanize next? Maybe in the metropolitan area or beyond. Sure. So.
Well, I think in the city, the areas that are poised for a lot of growth are the areas that are around transportation hubs out in the boroughs. I think over the last 5 or 10 years, city planning has done a great job of increasing zoning densities around the hubs, down zoning areas far away from transportation, and I think some of those areas really haven't caught up with what their dynamics suggest they should be doing.
The baby boomers and the Gen Y make up such a huge portion of the population. So if you start looking at all the cities, you have to look at cities that have a high walking IQ, amenities, and arts, and really are attracting the young people that are looking for great job opportunities. So interestingly enough, there's going to be some markets that typically were sort of looked down or considered even ugly, but are doing some really interesting things.
Well, listen, I think there's opportunity really all over Manhattan for each sector of the city. If you take it into sort of Midtown, Midtown East in particular, where we're developing 2 new office buildings in the Midtown South area, and then downtown. I think they're all different, and they all have a lot of things that are going on. I think one of the key things that has to happen in any one of those markets that we're talking about today is looking for the opportunity to create 21st century buildings.
Start with law firms. We certainly, I think if you look in New York and the other big market that we serve where we have law firms in Washington, and you look at the average law firm renewal, there's a reduction in their space when there's not a reduction in their head count.
Right.
So, and that number is all over the map, but, it's probably 10 to 20%, reduction. And I think that's going on for a bunch of reasons. One, certain segments of the legal industry are not doing as well as they used to. Certainly firm, transaction, numbers of transactions are down, for one, and I think that's impacting a number of practices.
The people that make these macro New York bets, I think that's the biggest risk. I think it's really got to be sub-market and buildings that you focus on, and really driven by where's the demand coming from? Where can you own buildings that tenants want to attract talent? And if they want to attract talent, they want to be in locations that help them attract that talent, and they're less sensitive about where rents are going to be, so you have more pricing power as you go forward.
Currently, e-commerce accounts for about 8% of total sales, total retail sales in the U.S., excluding automobile sales. So we think about it, it doesn't sound like a huge number, but obviously those numbers are in the billions. But the important thing is to watch what the trends are. So in the very important holiday selling season, which is typically considered to be November and December of every year, overall, these retail sales in the U.S. were up at about 3.5%. What's remarkable about that is that the online growth in retailing sales was up 22% year over year, while the sales in stores were up a rather modest 2.2%. So obviously, if you look at these numbers and you see the differentials in growth rates, this trend is going to have a continuing very profound impact.
In New York, that experience is still going to be critical. It's family, it's your friends, it's a social environment. There's the personal touch, there's the service that you get from going to a store, there's the rummaging through, finding that one-of-a-kind item that you were looking for, that you didn't know you came in to look for, but you found. It's good for the retailer because people visit stores. They end up buying more than they ever planned. So it's sort of like you're going to the store and you're not really sure what you're going to buy. People shop online. They pretty much specifically know what they're going to look for. And I'm happy to talk about that a little more. We've done some research. We're in the market with retailers all the time. This conversation is always happening, and landlords are curious about it. Tenants are curious about it. And I think it's a very hot topic.
So this started in '09. Everybody was right-sizing, and, I think we're kind of at the end of right-sizing, and we all know what the right size is now. So we're looking at our spaces and our merchandising plans and figuring out how to fit, those boxes into the spaces we have. If we're back 5 years ago, you'd have a number of tenants in the 35,000 to 50,000 square foot range. There's not that many people. They're more in the 20,000 square foot range.
I think that if it's someone entering the New York market and they want a flagship, they're still going for size. But I think that if it's a company that's in New York and they have multiple points of distribution in New York, they are downsizing.
So Marianne, why don't we kick things off with you? If you'd be so kind as to give us a snapshot of where you think the multifamily market is today, rental rates, vacancies, condo prices, completions, absorption, that kind of stuff.
You've got a lot of people you got a lot of opinions on the panel, so I'll start and then clearly others can jump in. But I think multifamily housing continues to be the darling of the development industry. It is really the product type that everyone's talking about. I think that will continue into 2014. I think on a sort of global scale, urban is in. What Robert Futterman said in the recent panel, the last panel, is spot on as it relates to the way people want to live. This Y-gen movement into cities and even baby boomers flocking to cities, great livable cities will continue to draw intellectual, cultural, and human capital into 2014.
The market in Manhattan right now, it's impossible to do anything rental. Land prices are just being priced to the astronomical condo market, and who knows if that'll continue. It seems like there's an unsatiated demand, and there's not a lot of product. And we see a lot of opportunity in the boroughs, and primarily Queens and Brooklyn as well.
But getting back to the bank side, if you're dealing with a lender that can book and hold that transaction, he's going to be extremely competitive. He'll match pricing and structure to long-term relationships or to acquire new relationships. Syndication has a little bit of those themes, but not as, it's still a little bit conservative because as an agent, you're still looking to liquidity, distribute the debt, and show a successful project that can be financed on behalf of sponsors from that end. So still a very strong market, probably the best it's been in the last 3 years as to availability. And it's driving prices of real estate and dealing with cap rates. I mean, that's one thing we see unusual.